what we're saying to people is run as much money through a policy as you possibly can. If you can get all your income through a policy, fantastic, but as much as you can, because you're going to be earning a rate of return on the total cash value. See, Steve, what most people are doing, maybe they're saving 5 or 10% of their money, they're investing 5 or 10% of their money, and they are hoping to get, let's say a 7% rate of return. Well, what if you were earning a 5% return on 50, 75, 100% of your money? That's volume-based banking. You're earning maybe a little lower return, but on a larger pool of money, you come out ahead. And we're going to prove that today. We're going to show some numbers.
Sounds good. Let's dive in. I'd like to see how you demonstrate volume.
Yeah. Firstly, we do want to go through a volume-based banking cash value illustration. This is a high cash value illustration that is properly designed that we talked about in a couple videos ago. We're assuming this person's income is somewhere between 250,000 and 500,000 a year, right? So if they're earning 500,000 a year, 50% of their income is going through a policy. So whatever that means to you, we make sure that we gear these numbers towards your specific situation. But in this case, 250,000 a year is going into a policy, and you'll notice that over 80% of the premium is available in first year cash value. The internal rate of return on this policy is 5.27%. Now, we're going to assume that this person lives to the age of 85. And the reason I'm doing that is because this is a life expectancy chart. If the person's 40 today, these are kind of fun to look at, and they're healthy, they will live another 45 years, which puts them at the age of 85. So this person only funded the policy for 20 years. 250,000 times 20 gives us the 5 million. So we see that cumulative premium, but 32 million at the age of 85 life expectancy. Now we're going to put this math into a truth concepts calculator. And what we see is this 250,000 going into the policy for 20 years, earning it's about a 5.27, 5.3% rate of return. And at the age of 85, 45 years later, look at that, $32.3 million. And you were only earning 5.27%. Now, I say only, this is a tax-free number. It's going to feel more like an 8 or 9% return taxable. But this is remarkable, Steve, because an insurance company gives you a guaranteed rate of return and a dividend. This is not a return that's tied to the stock market. There's
Uh,
not going to be losses. There's no volatility. You're making money every single year. And in this case, it's as if you would have earned 5.27% every year for the rest of your life. And
right.
remember this number,
Tax free.
32.3 million.
Right. Tax free. So if right, if you take that
Tax
5 point.
free.
So yeah, so I think that the thing to point out is that if you could think about it from a volume standpoint, if you could recapture your money into a system that has the guaranteed tax-free growth, what did you just do? Most people take all their money and put most of it in a bank. They maybe save some of it. And so they're getting taxed out of the chute, and they get penalized with it. And they're not ever harnessing momentum. So this is the whole principle behind volume based and getting as much of your volume of your money into this system as you possibly can,
Yep.
which is worth a lot.